wick play, bull flag, bull pennant, wedge pop, wedge drop, basin break, EMA crossback, exhaustion extension, reversal extension, outside reversals, inside bars, EPS flag breakouts, descending channels, descending wedges. You might be like, what on earth have I just clicked on? Well, this is a video explaining Oliver Kell's breakout strategy that he used to achieve a 941% return in 2020. I'm going to be teaching you both the technical aspect, so identify, control, mitigate, and optimize, but also looking at the fundamentals. I've incorporated MarketSmith charts into this presentation. They are today's video sponsor. There is a discounted MarketSmith trial in the comments section below. If you are interested, I'm going to show you this chart at the end of the presentation, and hopefully everything is just gonna click. So when you're trying to learn any strategy, I think it is prudent to break it down into 4 component parts. Number 1, how does that person identify their setups? Number 2, how does that person initially control their risk when trading those setups? Number 3, how does that person mitigate the risk when trading those setups? And number 4, how does that person optimize the profit from those setups? That is what we're going to be doing with Oliver Kell's breakout strategy. Now, I warn you at the start of this video, it is ridiculously complex at the beginning to really wrap your head around the concepts, because I have to teach you the market framework that Oliver is applying, which I started off a little bit earlier in the video. So his own cycle of price, as he calls it. We've got to start there. You've got to understand the terminology, and then there are lots of different entry setups. There are then different ways to control risk. There's different ways to then mitigate risk. There's different ways to optimize the profits, including adding on to positions. So you are probably going to have to watch this video twice. I'm being honest with you at the start. You're probably going to have to watch it twice, because I don't want to labor points and spend loads and loads of time on a single point. I think it's better if I go through the whole thing and then you watch it twice, and then hopefully on the second viewing it will just start clicking like that. So let's start here with a strategy overview. I consider myself to be an intermediate termed trend follower and swing trader. I am always looking for the strongest growth stocks with big earnings and sales and a game-changing story. For my longer term period trades, I want to find breakouts from big basing patterns. For my swing trades, I try to buy pullbacks or play shorter term continuation chart patterns. In the end, I'm a slave to price and use volume for clues. Once positioned, I utilize moving averages to ride the trends. A rule-based strategy with the ability to act on your gut feel, right or wrong, while managing the risk is the ultimate combination for big returns. Here are my tools for analysis. Very similar to Davis here. Price, volume, moving averages, multiple time frames, and chart patterns. Oliver's win rate around about 30-35%. So he's right roughly on 1 out of 3 trades. So the risk management side of things is going to be really important as we start diving into that a little bit later on. Now, I won't read all of these quotes out to you. You can read them in your own time. But William O'Neill, obviously founder of Investors Business Daily and MarketSmith, had a significant impact on Oliver Kell's strategy, as you're going to learn as we progress. So here we go. This chart here, you're going to be like, what does this mean? And you may actually turn off, because it's going to look really confusing at first. But what I've tried to do is break every single part down into its relevant components and teach you it step by step. And then as we start progressing, start adding and building on it, so you just follow it through. As I said, hopefully it makes sense, but you may have to watch it a couple of times for it to really sink in, because I don't want to spend loads of time here, lose you in the weeds at the beginning of the video. I'd rather take you through the whole thing and see where we get to at the end. So this is the cycle of price action. This is how Oliver contextualizes the market. So this here is the framework, and then the setups that he's looking for, how he's then controlling the risk, how he's managing the positions, looking to optimize profits, all stems from this, which is his framework for how he is viewing the market and individual stocks as well. Don't worry, all going to make sense as we go. So we have EMA crossbacks, we have basin breaks, we have exhaustion extension, we have wedge drops, EMA crossbacks to the downside, basin breaks to the downside, reversal extension, we got the wedge pop, EMA crossbacks, basin breaks, exhaustion extension, so on and so forth. The 10 EMA and the 21 EMA are very important to Oliver's strategy, which we'll get onto a little bit later. So let me just give you an overview, and this is going to make no sense to you at the start. I was thinking about, how am I going to film this video? Do I go in really in depth at the beginning? And I just went, no, you just need to go through the video and things will just start clicking. Reps and sets, reps and sets. But here you can start to see how Oliver is then, his contextual framework is applying to the market, and then is going to be applying to individual stocks. You get wedge drops, EMA crossbacks. We're going to do all the definitions in a couple of slides time. We've got definitions for each part here. Basin breaks, reversal extension, wedge pop, EMA crossback, EMA support, basin breaks to the upside, exhaustion extensions. It's all going to start making sense. So Let's now start breaking it down. So, cycle of price action. The market goes up when there are more buyers than sellers and goes down when there are more sellers than buyers. It's really that simple. It is just supply and demand. When a stock tops, turns into a downtrend, and then eventually bottoms out, it follows these steps: exhaustion, extension, wedge drop, EMA crossback, base and break, reversal, extension. Don't worry, it's all going to make sense. We've got a lot of examples to go through. When a stock bottoms, turns into an uptrend, and then eventually tops out, it followed these steps: reversal, extension, wedge pop, EMA crossback, base and break, exhaustion, extension. A little quote down here, which is a good one: if you miss the optimal buy point, I still think it is worth trying to be in the top liquid stocks versus a secondary stock. In those instances, paying attention to the price cycle or patterns like flags, pennants, or pullbacks to the moving averages may present opportunities. You can already see a couple of quotes about growth stocks, leading stocks, so you can start to see the influence William O'Neill had on Oliver's strategy. Here we go. These are the main chart patterns that Oliver is looking to trade. So we're just in the identify part here. So when you are seeing the EMA crossbacks, which will make no sense to you at the minute, the base and breaks, which will make no sense to you at the minute, Oliver is looking for these kind of patterns. Also, to a lesser extent on the wedge pop, they're more descending channels and descending wedges. Don't worry, we'll get there. So in essence, he is looking for flags, triangles, pennants, VCPs, cup and handles, wedges, so VCP, kind of low mid pivots, flat bases, and then there's a couple of other ones in terms of bull flags and bull pennants. So a bull flag, now I will just say this at the start of the video, Oliver is very, very active, very aggressive with getting into positions as well. So he'll trade some bull flags and some bull pennants from bases that are 3 days long, 5 days long. So you're going to see examples of that. So it's not kind of the classic, say an O'Neill and a high type flag. He would want minimum base duration of 3 weeks. Oliver, in the context of his price cycle, he is looking for bull pennants, bull flags into key moving averages, which can often be the 10 EMA. So the difference between a bull flag and a bull pennant, for which you are going to see a lot in this presentation, is a bull flag is basically making a series of lower highs and lower lows, whereas a bull pennant is making a series of lower highs but higher lows. That there is basically the difference. But you're going to see these ones. You are also going to see a couple of other ones, a double bottom base, which also Trader Vic, who came up with the 2B reversal, which is basically kind of a Wyckoff spring in a way as well. You can oftentimes see this as well. So Oliver is aware of springs and things like that in these bases as well. I've actually got an example to show you, and then obviously the traditional O'Neill cup and handle, a little bit of kind of a description there for you as well. But you probably haven't really come across a 2B reversal or a double bottom pattern, so I thought I would just put a little slide in here. So a double bottom pattern, it basically looks like a W, okay, like this. I don't know if that was the right way out for you guys, probably. So see how the market comes down, it makes a low, see how it actually holds around the key moving averages, we'll get into all this later, bounces, come down, undercut, and then here is the 2B reversal, shake out demand tail, open on the low, recovery, then it tightens up, look at this inside bar coming in, look at the volume coming through, and then the breakout. But you probably haven't seen really a double base type pattern before, so I thought I would just include this one here. Now, that cycle of price action, we now need to start breaking down those component parts with definitions, so you at least now start to understand the definitions. And then we have got various examples to be going through. I think we've got Tesla, and I also think we have got Zoom as well, and then plenty of other ones. And what I've tried to do is make this interactive, included quizzes for you as we progress. So reversal extension, this is the bottoming part of the cycle. So here you can see, imagine that price is doing this, and then our price is the white line here. So look for a defined support level on a higher time frame. When price approaches the higher time frame level, it must be extended from the 10 EMA on the lower time frame chart, air between price and the moving averages. When the stock starts to put in a reversal bar, go long. Heavy volume capitulation on the reversal bar is a key ingredient in this setup. Initial stops go below the low of the reversal bar area. First profit target is the 20 EMA on the trading time frame. Stops move to cost when partials are taken with discretion used to exit the remaining shares. And you might be like, what? This is initially, to get your head around it, a very complex strategy, but it all makes sense come the end. But you've got to understand all the component parts. So Oliver will rarely trade a reversal extension on a higher time frame, being the weekly or the daily chart, but he will utilize this if a higher time frame, so say the daily chart in a leading stock, is pulling back to say the 21 EMA or the 20 EMA as Oliver uses on his charts. He could then go down to a 5-minute chart, as the quote over here says, to then look for the reversal extension to try and get positioned off a key moving average. Now I'm just going to take you through that. Ready? Here we go. So here we have NVIDIA. This is from this year, 2023. So you can see that for me on my chart, I use the 21 EMA. So throughout my charts, you're going to see black line 10 EMA, blue line 21 EMA, purple line 50 SMA, grey line 100 SMA, and the red line just poking its head out there is the 200 SMA. So where do you see that NVIDIA has, generally speaking, been finding support? 21, 21 over here, 21, undercut the 21, then recovered, 21 in here, and then it pulls back down to the 21 in here. So what you can then do, if you see a leading stock pulling back to a key moving average, in this instance here it's a 21 EMA, we could think about it as the 50 SMA as well. But what we could then do is look for reversal extensions on the lower time frames. I'm already going really in depth. This video is going to be extremely in depth, okay? It is just a really in depth video. Here we go. So remember this level here of $272.40 on the daily chart, okay? That was the 21 EMA where we can see NVIDIA has been for finding supportive action. So here is the 5-minute chart looking at this. Now you are looking for basically capitulation type bottom on the reversal extensions down. So we're on the 5-minute chart here and we're looking for evidence that large operators are stepping up. So what do we see? We see multiple what I call demand tails. So demand tails coming down, and look at the high relative volume. So the stock on the higher time frame is finding supportive action around the 21 EMA, which is an area we know leading stocks tend to be supported. So this here is the reversal extension. This will all make a little bit more sense as we do some more reps and sets. Here is on. So you can see that on is trending up here, first pullback to the 21 EMA, and here is the 5-minute chart here. So see how it's a reversal extension. Price is extended to the downside versus the 10 EMA and also the 21 EMA. Perfect shakeout demand tail, and then starts bouncing off. So see this $30.60 level. Where is this on the daily chart? It's pretty much right there on the 21 EMA. So Oliver will use the reversal extension on leading stocks as they are pulling back down to potentially key moving averages, such as the 21 EMA, potentially the 50 SMA if it's in a bigger base, but it is more so focused on the quicker moving averages, 10 EMA and also the 21 EMA for Oliver's charts, but using the multiple timeframes. That is going to be all we're going to be talking about on multiple timeframes for a little while now, but I did just want to show you this as it's something probably a little bit new for you. Oliver will also use outside reversal bars that you're going to learn much later in the presentation around key moving averages, so kind of gap down reversal bars. Don't worry, we are going to get there. So after the reversal extension, you then get the wedge pop. So this is the first time the market trades back up across the moving averages, being the 10 EMA and the 21 EMA, after a reversal extension where price has been on a short-term basis extended to the downside versus the 10 EMA and also the 20 EMA. Price trades in a tight range as it works lower. Often for longs, the stock is showing relative strength to the underlying index. So even though the stock is below its key moving averages, it is showing relative strength. Relative strength is going to be a huge part of this presentation and a significant part of Oliver's strategy. So we're going to spend a lot of time on that. The 1021 EMA should be tightening, showing a lack of overall momentum despite being dragged in the direction of the underlying market. When price recaptures the tight 1021 EMA, go long with a stop below the near-term price consolidation. Ride the EMAs as a trailing stop once the trade triggers. For me, this is the money pattern. This is what I really like to play on the daily chart. I love breakaway gaps as part of the wedge pop, so we're actually gaps up above the 1021 EMA. I think it's a key ingredient. I didn't mean to elbow my desk then. So we're going to do loads of examples. I'm just giving you an overview of things, and we got example after example after example. So the EMA crossback. What on earth is an EMA crossback? So what part would this be down here? This would be the wedge pop, and then we're looking at the EMA crossback. So this is the first retest of the moving averages following a wedge pop. So price has been extended to the downside. That's the reversal extension. The wedge pop is back through the 10 and the 20 EMA, and then the EMA crossback is the first pullback in to the key moving averages. So price has already recaptured the 1021 EMA. On the chart, being the wedge pop to be a candidate, it then pulls back into the 1021 EMAs for the first time. Buy the stock against, so as it's pulling in, buy the stock against the 1021 EMAs. Don't worry, we've got loads of examples. I know this is completely over your head right now, but by the end, it should all start clicking. Really hopeful that is the case. Stops are placed below the moving averages, raise stops in a trailing format with the 1021 EMAs. You might be like, what do you mean raise stops? Don't worry, we'll get there by the end. So next one, afterwards in the price cycle, is the base and break. So we've had reversal extension, wedge pop, EMA crossback, now the base and break. Price will build a basing pattern finding support at the 1021 EMAs. This is often a slightly longer consolidation rather than a short 1 to day 3 pullback. So that is much more so. It could be the handle in your cup and handle type pattern. It could be a flag. It could be a VCP of sorts, a flat base, so a Darvis box, a wedge, something like that. Okay. Buy against the moving averages with confirmation adds on the base breakout. So this is something that you're going to see a lot. Oliver likes to buy in pieces. So we'll get into this as the presentation goes. He's actually buying against the moving averages. So remember those reversal extensions I was just telling you? Oliver is an extremely active trader from what I can make out. So he's buying parts of his position into the key moving averages and then adding to his position on various breakouts. So it could be a breakout for a high, breakout for a trend line, so on and so forth. Stops are placed at a loss of the moving averages. Ride the moving averages higher while selling into pops away from the 10 EMA with final stops at loss of the 10 EMA. We're going to go all in to selling and optimizing profits. Good quote here, you don't want to be buying stocks that show air to the 10 day. So I are extended from the 10 EMA. So you see here on this schematic up here, there would be air between price and the 10 here, whereas here it is much closer. So again, it's kind of judging it relative basis. We'll go into deliberate practice, how you can really train your skill set here. This is a nice quote here. It's not about knowing where the stock's going to go. It's about finding low risk spots where you can execute and manage risk. That's what technical analysis is all about. So after you get the base and break, you then get the exhaustion extension. Now, you'll see on some of the charts, sometimes it says exhaustive extension. That's because I'm dyslexic and I wrote the wrong word and I couldn't be asked to then go and change it. But you know what I mean? It's an exhaustion extension. This is the blow off euphoria and a sign the market may be topping. The further you get into an uptrend and the more extensions you get away from the 10 EMA, the more likely a stock is to rebase. The second extension from the 10 EMA, don't worry, got loads of examples, is generally a good place to take profits. If you get a third extension, you are often getting late in the intermediate term trend. Also, pay attention to first and second extensions away from the weekly 10 SMA, which is the daily 50 SMA, so simple moving averages. Then on the downside, after you get the exhaustion extension, you then get the wedge drop where price is coming back down through the moving averages, being the 10 EMA and the 21 EMA. This could be triggering your stop losses as well, and we'll get into that later on in the optimizing profits. The next is the EMA crossback. This is where you've had your wedge drop down and then price rallies back up into those key moving averages. It could be 1, it could be 2, it could be 3 of them as well, potentially say if the 50s there, but much more common for the type of momentum growth stocks Oliver's trading is going to be the 10 EMA and all the 21 EMA. So you get the wedge drop that loses them and then it rallies back into them, forms a structural lower high and then finds resistance and then rolls back over. Base and break is basically basing, so it's a little bit longer in terms of a consolidation, is basing into the key moving averages. So you could see some form of kind of like just Darvis box kind of rectangle, to use a visual example. Okay, something where price is consolidating and then the moving averages are catching up, but it can't reclaim them, and then it breaks to the downside like this and then makes a series of lower lows. So timeframes. What timeframes does Oliver use? Well, he says the highest timeframe supersedes the lower timeframe. What does that mean? He gives more weight to the monthly chart than he would the weekly chart, and he gives more weight to the weekly chart than he would the daily chart. He gives more weight to the daily chart versus the 1 hour chart. Hopefully that makes sense. The weekly is the anchor. The daily is for trade management. Intraday, he uses the 1 hour and the 15-minute time frame. He says he rarely uses the 5-minute chart, but sometimes he does. But for the initial risk management, he's using the 1 hour and the 50-minute. He does say if there is not a setup on the higher time frame, so that is the weekly chart or the daily chart, there is no point looking at the intraday chart because you'll get so many false signals and you'll just start over trading. So let's now start putting it all together a little bit. We've got Tesla to be going through like this, and then we have Zoom to be going through like this. And by the time we've gone through Tesla and Zoom, hopefully a couple of these things are starting to make a little bit of sense in terms of what on earth is an EMA crossback, what is a wedge drop, what is a wedge pop, what does an exhaustion and extension look like, what does a base and break look like. We're going to get to it. We'll explain it all as we go. So let's start from the high. So let's start point A. This is an exhaustion extension. Parabolic rally extended from the 10 EMA. Look how this thing here has just run up. So remember, black line is 10 EMA, and on my chart, the blue line is the 21 EMA. They are the two to really focus on, the black line and the blue line. Okay, so this here is parabolic, it's clearly extended from the 10 EMA. Then at point B, we have the wedge drop. So price drops through the 10 EMA, and you can see the change of character on this bar here. It's a widespread red candlestick. The volume had popped up as well on this bar. It's a clear change of character. It's a wedge drop. Then you have the EMA crossback. So see how price goes down and then it rallies back into the black and the blue line, the 10 EMA and the 21 EMA. It actually gaps up above it and then loses it, closes weak below them. That's an EMA crossback. So like the wedge pop is the first move back above the moving averages, and then the EMA crossback is the first test into them. The wedge drop followed by the EMA crossback is losing the moving averages, then rallying into the moving averages and losing them. That's the EMA crossback. Then as we go down to D, this is the reversal extension. So price is now extended to the downside relative to the 10 EMA. And it also finds supportive action on the 200 SMA. It's showing a lot of relative strength. We may actually look at this one a little bit later on so I can show you the relative strength point. Then at point E, price has traded back up to the 21 EMA, pulls down here, and then here is the wedge pop. And I know I've pointed to the entry points. We're going to be going deep into the actual entry points. How do you actually get into the position? Again, I'm just starting up here, giving you an overview, then going down. This is extremely concept. When I started putting this PowerPoint presentation together to try and teach it, I was like, oh my word, this is going to really take some explaining to try and get this across in the space of an hour or 2 hour YouTube video. So as I said, you may have to watch it a couple of times. But this is the wedge pop. Okay, so it reclaims this bar here. See how it reclaims the black line and the blue line being the 10 and 21 EMA. Then at point F, this is the EMA crossback where it pulls back in to the 21 EMA for the first time and actually finds supportive action. Then as we go over to G, we then get the base and break. And what can slim chart pattern do you see? Cup, handle. So the base and break will often be, in terms of a cup and handle, the base and break will often be that kind of classic handle phase of a cup and a handle. Now the cycle continues. So here you can see G, this was where that handle was building. So you get the breakout here, the base and break, and then at point H we get another base and break. So see how price pulls into the key moving averages, and remember I was talking about some of the reversal extensions off of the key moving averages. So where is Tesla finding support? 21 EMA, 21 EMA, 21 EMA, 21 EMA, kind of undercut the 21 EMA, then it goes again. So these leading stocks can often find support around their 20 EMA or their 21 EMA. They are pretty much both the same things. So I know Oliver uses the 20 EMA, I use the 21. So if I say 21 EMA instead of 20 EMA, that's just because I'm very used to using the 21 EMA, but I mean the same thing pretty much, okay? H, so you see another base and break. So price consolidates above the 10 and 21 EMA's opportunity to initiate or add to the position while adjusting stops higher underneath the key moving averages, being the 10 EMA and the 20 EMA. We'll come on to actually trailing stops a little bit later. Then at point I, you get your first extension. So this is a blow off exhaustion. So extension from the 10 EMA with a gap reversal on high volume. So price actually gaps up, supply shoot taking it up, and then it comes back down. This is the first extension. So we want to be aware of a first extension and then a second extension. It is then rare to see a third extension. We're going to come on to extensions a little bit later on. Then you can see at J1 and J2, this is where we have the wedge drops. So price wedge drops through the 10 EMA here, and then we wedge drop through the 10 and 21 EMA in this vicinity. But then at point K, we get the wedge pop. So the wedge pop is back up through the key moving averages, and you get a nice downwards trend line coming through here. So a bit of a downwards channel, a downwards wedge more so than a downwards channel coming through in this region here. And then at point L, we get the second extension. So Oliver is very aware of when we're coming out of large bases, then how many extensions you're likely to get. Potentially 2. It is very rare to see a third extension. And this kind of goes into William O'Neill's base count. 4-stage bases, 5th-stage bases are very failure prone, and this kind of links into the extensions that you'll see. Next slide here. So this is where we're looking at here at point L. So it's going to take longer for the stock to rebase out. So at point M, there's another base and break which turns around and fails. You are going to have failed trades. At point N, there is then a wedge drop. So see how it closes down through the 10 and the 21 EMA. Then at this point here, O, this is where it wedge pops. So see how it's underneath the 10, 21 and 50. And then here it actually wedge pops up. And this was the inclusion of Tesla into the S&P 500. So it was a catalyst which makes it a stronger breakout, and it takes out this pivot here. So it takes out the pivot, starts trending up to P. Now P is a blow off extension, so you could think about this as a first extension potentially as well. So it's extended from the 10 EMA, pulls back into Q. So Q is your EMA crossback. So EMA crossback, first pullback to the key moving average, potentially a place to add there if you're using, say, the 10, and then you're on the lower time frame. So you're thinking about a higher time frame, first pullback to the 10 EMA or the 21 EMA, and then you could be looking, as I showed you with Nvidia and on earlier on, the reversal extension on the lower time frame, such as say the 5-minute chart or the 15-minute chart. But again, Oliver is extremely active. Then you get R. So R is a basin break, which kind of goes for a day, turns around and fails. Then you get this bull flag that comes through, so then there's a potential entry there. Then at S, you get another kind of blow off extension. So this one here is extremely extended. Look at the run that Tesla has had. T is then a failed basin break, but you're getting fairly long in the move here. And then U is a convincing loss of the 10 and 21 EMA, so kind of bearish synchronicity, but look at the increasing price volatility coming through. So increasing price volatility, as you will see throughout this presentation, increasing price volatility is more so associated with a lot of supply coming to the market and distribution, where decreasing price volatility is a signal of the other. So it's actually that there is absorption of supply and less supply coming to the market. This is what it looks like when you piece it all together. So here is your traditional cup and handle. So from A to G, this being the cup, then this being the handle where it tightens, and then you get your first extension into I, pull back, second extension into L, a big base then builds, and then you get kind of your first extension into P, pull back, and then your second extension into S here. So be aware of kind of the extension points as well. But as we do more reps and sets, it's all going to start coming together. Now the price cycle is also applicable if you are trading the weekly time frame. So this here is Peloton, and I know these kind of arrows where I've drawn things and stuff, at the minute it's a little bit wishy-washy, it's a little bit vague, it's a little bit fluffy. I appreciate that, but I have to start off higher, give you an overview, and then start going into the weeds. You need to understand the concept before you start applying the tactics. So you need to understand the strategy and then the tactics to implement the strategy. Hopefully that there makes sense. So you can see major IPO, so it's a flat base, which is a cancelling pattern. Flat base, see how it tightens in here? So what was I saying on the last chart? Decreasing volatility is a sign of absorption of supply and less supply coming to the market. So these tight candlesticks, whether it's on the monthly chart, the weekly chart, the daily chart, the 1 hour chart, the 5-minute chart, the 1 minute chart, they are very constructive to see for a breakout, because they tell you either there's absorption of supply if it's kind of higher relative volume, or there's very little supply if there's very little relative volume coming through. They're really good to see. At B, you get your basin break. At C, you get your stage 2 flat base. So here's a flat base. At D, you get your exhaustion extension. So this is kind of potentially the first one here, albeit it is fairly extended. At E, you get your EMA pullback support. So I use the 21 EMA, so you can see that's roughly finding support around that. F, you get a stage 3 base. So see how it's getting all a little bit kind of wide and loose. G, you get your second exhaustion extension from the 10 week. So you see this black line here. Remember, be aware of exhaustion extension. So we were looking at on the daily chart with Tesla, first extension pullback, then the second extension happens on the weekly, but more so from the black line, which is the 10-week simple moving average, which on the daily chart is the 50 SMA. So see how you get your first extension, pull back, then your second extension. It is very rare to get a third extension higher. So something to be aware of, and then to put that in kind of the context as well. So this then links into the Wyckoff price cycle, Stan Weinstein state analysis, phase 1, phase 2, phase 3 distributional top, phase 4 decline. H is a failed breakout, and it's very volatile in here as well. I is then your stage 4 base, and then you can see at J it's just taking out these lows, and that is then going into the stage 4 mark down. Let's run through Zoom as we did with Tesla, and again, hopefully these things will just start clicking as we go throughout. So A, this is the wedge pop through the 10 and 21 EMA. So see how Zoom is actually basing here. You get this tightness in terms of price volatility, and then you get this pop through the 10, 21 EMA. What is that? It's a wedge pop, and then the stop lower the breakout day. So Oliver will trade these wedge pops through, and don't worry, we've got lots and lots of examples. I got some quizzes in a couple of slides time as well. So this is the wedge pop that actually loses this trend line here at B, which is then a wedge drop. At C, it's another wedge pop back through the 10 and 21 EMAs. Then over here at D, price finds support around the key moving averages. So the 10 EMA, the black line here, is catching up, and then at point E here you get the breakout, and this is a wick play. You're going to learn all about wick plays. I think I got like 5 examples, if not more examples, a little bit later on to be showing you. At point E, we get a basin break. So at point E here, we get a basin break. Point F is the first extension. So you can see visually how it's kind of extended from the 10 EMA here. So okay, we get an extension there. Then at G, you actually get a gap up exhaustion extension. So you see how I've written exhausted there, that's my dyslexia kicking in there, but you see how it actually gaps up and then starts getting very, very volatile here. And then at H, it's another exhaustion extension, so you're kind of getting like 1, 2, 3. Okay, it's indicating there's some distribution, stock's getting a bit volatile, some supply coming to the market, needs to probably pull back, tighten up, which is then what we see at point I. See how it pulls into the 10 and 21 EMA, so the black line and this blue line here starts to tighten. There's your breakout going through. Then at J, you get another exhaustion extension, and then at K, you get the wedge drop, and you also lose this downwards trend line. But then you see how the stock finds supportive action around the 50 SMA. So that's where you can look for the reversal extensions on the lower time frame. Let's keep going. So at point number L, this is our wedge pop. So it pulls down, zoom pulls down, finds support around the 50 SMA, and then the wedge pop is back up through what two moving averages? The 10 EMA and the 21 EMA. Now at point M, this is the EMA crossback. So the EMA crossback is the first test of the moving averages. So that could be the 10 EMA and or the 20 EMA after the wedge pop. So the first test of those moving averages after the wedge pop. At N is a basin break, which goes for about 2 days, turns around and then fails. So O up. O is a gap up exhaustion extension, pulls back down, the stock rebases. Then at P, you get your base and break. So you see how the stock builds a decent base. There's your base and break. And then at Q, this is your EMA crossback, which also turns into a little bit of a bull flag / bull pennant type pattern in here. So see how it pulls back down in here. Now again, Oliver will trade these aggressive shorter bases in the context of an uptrend from 3-5 day bases, assuming the 10 EMA, there's no air from the 10 EMA. So you are going to see plenty of these ones here. At point R, you can see that EMA support rises. So EMA support, so raise stop to the 10 EMA. So you see how the 10 EMA is just basically supporting the stock, but you then start to form this trend line here. And then at S, you get your 3 signals actually. You get a bearish engulfing candlestick, which is also a trend line break and is also a 10 EMA break sell signal. So again, kind of 3 confluences there. So it's losing the moving averages, it's breaking the trend line, and it's a terrible looking candlestick. It's a bearish engulfing type candlestick. Let's go on to the next one. So I'm now going to start asking you some questions. So this is kind of towards the end of the overview section, then we're going to start getting really deep in it. So hopefully you're getting a little bit familiar with Oliver's terminology. This is a whole kind of market framework to be thinking about it. So that there was a little bit, well, it was an overview of it, but now I need to start asking you questions to make sure that you are following along and you get it. So here's a chart of Nvidia. Can you identify where the wedge pop is? I'll give you 3 seconds. 3, 2, 1. There it is. Hopefully you got it. So remember, the wedge pop is when it gets back through. See how it tightens in here, puts in a structural high low, and then it reclaims the 10 EMA and the 21 EMA. So it's the first reclaim of the 1021 EMA. That's really, really good to see. There is technically one here, but see how it's still pretty volatile. You want to see some tightness in price, ideally higher lows coming through before that as well. And even better if you get kind of a tight inside bar on low relative volume before a wedge pop. So now you've got a couple to try and find on this one, okay, this Teladoc. So can you identify a wedge pop, an EMA crossback, a bull pennant breakout, an exhaustion extension, and then the wedge drop? So I'm asking you, I think, 5 things there. Ready? 3, 2, 1. See if you can get them. So here is the wedge pop. See how it pops back up, reclaims the 10 and 21 EMA. Look out the tightness coming through in here as well. See how the stock was building higher lows. You then get the bull pennant breakout. So the stock is building lower highs in here, but it's then also building higher lows. So remember, the difference between a bull pennant is the fact that it's building lower highs but higher lows, and a bull flag is building lower lows and lower highs as well. So the difference is the higher lows coming through with a bull pennant. So see, here's the bull pennant, then this is the exhaustion extension up here. Here was also the EMA crossback. So first test after the wedge pop. So there's the wedge pop, first pull back into the key moving averages, and then here is obviously the wedge drop. Clear change of character, and it takes out not 1 but 2 key moving averages, being the 10 and also the 20. Let's do another one. So this is on the NASDAQ. So can you identify the wedge pop, and a bonus if you can also get the chart pattern? So there's a chart pattern here as well. So I'll give you 3, 2, 1. Here you go. Here is the wedge pop. So see the tightness that comes through, see the higher low that forms, look at the tightness, and then the first reclaim of the 10 and 21 EMA, and see how it opens on the low, closes on the high, and it's a little gap up as well. And it was an inverted head and shoulders type pattern. Here's the left shoulder, here's the head, here's the right shoulder over here. Now a couple for you to try and identify. Can you identify the wedge pop, 2 exhaustion extensions, and the wedge drop? You ready? 3, 2, 1. There you go. Here's the wedge pop. So you can see, pulls back down here, starts putting in this higher low. So do you see the commonality here, the repeatable nature of invariably before the wedge pop, there's a higher low. So price puts in a higher low, then makes the wedge pop. So see here, this here is a structural higher low relative to this low here. And then here is the exhaustion extension. Here's another exhaustion extension. As I said, my dyslexia was having a field day there. I was writing exhaustive extension. That's just my dyslexia. And then you see here, this is the wedge drop coming through in here. You clearly lose the 21 EMA. That is not a good looking candlestick. So this is then quite interesting. Here we have on the right hand side, we have AMD. And then I've tried to line up here the NASDAQ composite as well. Now this is feeding into the relative strength point as well. So where is the wedge pop slash low pivot breakout for AMD? Well, I've kind of pointed to it, haven't I? It's Wednesday the 13th of October. Do you see how AMD here made a higher low and the index made a higher low coming through here as well? And then the very next day, the index will have its wedge pop, but AMD has its wedge pop the day before, and see how it's reclaimed the 1021 and the 50 SMA. So on this day here, on the 13th, okay, or actually on, well, we could look at the 13th, but if you look at the 12th, okay, the market being the NASDAQ, so the NASDAQ 100 is below the 10 EMA, the 21 EMA, and the 50 SMA, whereas take a look at AMD, see how it's just basically building this mini pivot, this mini Davis box, and it's sitting there on the 10 and 21 EMA, and the 50 SMA is just above. So then you get the wedge pop for AMD, but it was showing relative strength. It's also a wick play, which I will teach you a little bit later on. So here we go. Can you identify the key moment? And again, you can print screen this, you can print it out, you can try and mark it, you can pause the video and go through it. So there's a lot of different key moments on this chart. So again, I want it to try and be engaging for you. If I involve you, I think you are going to learn much better. So can you identify for the cycle of price action, the key moments on this chart? 3, 2, 1. There you go. So to begin with, we have the exhaustion and extension. Then we have the wedge drop. We pull back down here. We build this descending channel. We have the wedge pop. We then have an EMA crossback. We then go up. We kind of fail. Then here we pull back down. There's a wedge drop here. Descending channel with another wedge pop. Then we pull back down. This would be the EMA crossback in here. You then have a basin break in here. Another basin break. See how the market is then finding support on the 21 EMA. 21 EMA in here. Another basin break. And then a wedge drop coming through in here. So this terminology of wedge drops, wedge pops, crossbacks, exhaustion extensions, basin breaks, reversal extensions is Oliver's way of trying to decipher the kind of puzzle of the market, if you like. Now, something on the market environment, because obviously this is a momentum-based breakout strategy, so it is going to perform better in certain market environments. What are those market environments? Let's get into it. So generally, when trading growth stocks, the NASDAQ composite or the QQQ ETF is the index reflective of those underlying stocks. When it's below the 20 EMA, it's better to be cautious, raise cash, or be far more selective in taking new opportunities. So these red zones are pretty much when the market is below its 20 EMA. Again, as I say, I use the 21 EMA on my charts. They're pretty much of a muchness, guys. And then the green zones are to indicate when the price is basically above the 21 EMA, so i.e. the market is trending up. On shorting, I find it more difficult to play the short side. Because of that, I do not often short or am much less aggressive in shorting stocks on margin. As mentioned above, if the QQQ EMA, if below, so if price on the QQQ EMA, if price is below, it's if I said that really badly, didn't I? I'm even going to keep it in. I'm not going to edit it out. So if the triple Qs is trending below, it's 20 EMA. We got there, didn't we? We are in a less than an ideal market. Margin is to be used when progress is being made and the stars are aligned. So save margin, what Oliver is basically saying, for when the market is trending up and you're making a lot of progress and breakouts are working on big winners. The next big winners are found during corrections. They are found by screening for stocks that hold up better than the market. So this is the relative strength point we're going to come on to a little bit later on. One of the main reasons not to short stocks is because it may distract you from uncovering the next big winner. So here you can see Oliver is primarily, and I would say, just primarily focused on trading the long side and does not do much shorting because he thinks it's much harder, and he also thinks it may psychologically distract him from trying to find the biggest winners. It's very difficult to be shorting stocks and looking for big winners at the same time psychologically. Maybe some of you are psychological geniuses and you can do it. Absolutely crack on. So can you spot the setups for TTD? So I've got a couple of quizzes now. We're going to start testing your knowledge, and then once we've done this bit, we're really going to start getting into the weeds on various other parts of the process. So can you locate the wedge pop, EMA crossback, and the base and break? Bonus, what can slim chart pattern do you see? 3, 2, 1, here we go. There you go. So here we have the wedge pop, reclaims the 10 EMA here. It's a very bullish bar. Ideally it would have got above the 21 EMA as well, but certainly in here this is then your wedge pop in here, but here the wedge pop. Then you have your EMA crossback, which is the first retest of pretty much the 1021 EMAs after the wedge pop, and then the kind of traditional base and break comes here within the context of the handle. And here you have your EMA support, you have your shakeout before the base and break. These shakeout gap down reversal bars are really good to see. Quote by Oliver, I think if you use my price cycle, you can often get in before the handle. So talking about the cup and handle, the bottom of the cup is usually a wedge pop, as you can see here, and the handle is usually in the form of a base and break. So again, this is how he's contextualizing the market. So now we've got net Cloudflare loaded up. Can you locate the wedge pop, the EMA crossback, and the short bull flag? So there's 3 things to try and get on this one. Ready? 3, 2, 1. There we go. So here's the wedge pop. See how it reclaims the 1021 EMA, reclaims all the key moving averages. Here is the EMA crossback. So see how it finds then support on the 10 EMA for the first time after the wedge pop. And here is the bull flag. So I was not joking earlier on when I said Oliver will trade 3-day bull flags. There is one there, but there's no air really from the 10 EMA. See how it's not kind of, what's a good example? It's not like up here. See how here there's kind of air from the 10 EMA, i.e. distance from the 10 EMA. Well, this is pretty close to the 10 EMA. So they've got to be pretty close for Oliver to trade these short-term patterns to the 10 EMA. So these are Oliver's 3 favorite setups that I'm now going to start going into. So Oliver's favorite setups to trade is the post earnings per share flag. So that is basically when there has been a gap up on the earnings and then it builds a flag. Got some examples. The descending channel and wedge. So he treats those as the same. They are usually wedge pops, which, as we said at the beginning of the presentation, is quote that there is the money pattern for him. And then also you've probably heard of the wick play. So this is the post EPS flag base. Let's take a look at it. So we've got Asana loaded up here. So note the context. This is building an almighty base. In my mind, it's still a little bit kind of wide and loose up here, but you get this earnings move up and then it starts to build this flag. So this orange zone in here, this is what we are focused on here. You can see the earnings bar coming through. So I'll read the quotes out to you and then we're going to start getting more into the entry tactics now, okay? So we're now thinking about the context of the market via the cycle of price action. So we're thinking about wedge pops, we're thinking about EMA crossbacks, we're thinking about base and breaks, we're then thinking about continuation type patterns, bull flags and bull pennants, and now we're starting to get into the weeds in terms of entry tactics, and then we're going to get into initial stops as well. So this is a setup I preferred more than the earnings gap and go. So Oliver would rather trade this than just buying it on the earnings. So he does do the buyable gap up, which is kind of a William O'Neill disciples point in their book, Dr. K and Jill Morales, if you want to go and read about that. Because Oliver said he prefers the post earnings per share flag base, I haven't spoken about the buyable gap up. I'm going to talk about this setup instead, but he does play the earnings gap ups as well. But I thought because he said he prefers this, I would talk about this setup more so than just a buyable gap up on the earnings. This setup may be my favorite pattern to trade, hence why I'm including it, right? It's not uncommon for me to buy day one being the earnings gap up, get stopped out and then re-engage on this pattern. I love this pattern. So when we're looking at Asana here, this quote links to this. You could start buying this into the moving averages. So see here, you get the earnings gap up and then it pulls back down near the 10 EMA. That's where you could be looking for your reversal extension that I showed you on NVIDIA and on at the beginning of this video. Add some more through this breakout. So you see how you get this little downwards trend line coming through here and it starts taking out these highs. It's actually then an inside bar and starts taking it out. So Oliver's then saying add some there and then some more through the pivot high. So basically as it takes out the high of the earnings. That's nice because you buy in 2 to 3 spots and raising your stop loss. So each time he's then buying, if he's starting here, then he's adding here and he's adding here. As he's adding, he's raising his stop loss up. May have lost some of you there. As we go into the control and mitigate section, we're going to be going through these examples of the entry and then raising the stop loss up. Okay, so then you're increasing your position size, but you're not increasing your risk. We'll talk about that very thoroughly a little bit later on. This here is a descending channel. Outside of the post EPS flag, I think this might be my favorite pattern. This is a multi-week pattern of lower highs and lower lows on the daily chart. What's key is towards the end of the pattern, you'll start to see the price action tighten, and at some point you'll see some sort of structural higher low. So here with Nvidia, price actually gaps down and reverses on this bar, and it puts in this structural higher low, and then the wedge pop comes through. So the higher low, it's a change of character. This descending channel nearly always lines up with a wedge pop. Oftentimes there'll be 6 touch points. So 1, 2, 3, 4, 5, 6. So oftentimes you will see 6 touch points with a descending channel, basically 3 on the top, 3 on the bottom as well, and then the wedge pop. And as we know, Oliver liked wedge pops, and he also says unfilled gaps are a sign of strength. So you actually get an unfilled gap here, an unfilled gap here as well, and then you actually get a little kind of unfilled gap in here too, but certainly more pronounced is this first one and the second one. Unfilled gaps are a sign of strength, especially if it's a stock like an Nvidia or an AMD, so on and so forth. It's a sign that institutions are stepping in and buying it. And then you can see various bull flag, and then the exhaustion extension up here. So Oliver will buy these much shorter bull flags. Here you can see this is what, 4 or 5 day bull flag. This is a 4 or 5 day bull flag. This is a 3 day bull flag. So he will buy those bull flags in the kind of TMO, true market leader type stock, in the context of an uptrend, which is extremely aggressive, not waiting for the longer term basis. He's very active in his trading. He's sitting there in front of the screen. If you cannot sit there in front of the screen, I think you will find it hard to implement many of his strategies. Next one is the descending wedge. Very similar to the descending channel. So it's similar to the descending channel, but the pattern converges more. The pattern has lower highs and lower lows, but the lower lows become less pronounced to the downside. So you see how it's making lower lows, but it's not making as aggressive kind of lower lows as an Nvidia was. It's price is basically finding it harder to go to the downside. And then at the bottom, these lows here, you're looking for evidence, ideally, that large operators are stepping up and trying to buy it. And the two things large operators require above everything else is perceived value and liquidity. Okay, they're the ones that create the lower highs, or the lower highs within the base. So be on the lookout for these shakeout demand tails where prices going down in the session, then being bought up. You could also get a gap down reversal bar. So you see on Nvidia here, the prior close is here at what's that, around about $100 and $140, and then it gaps down on the open to around about $135. The open is the low of the day, and then it pushes up. That there is an immediate sign of demand. It must be. On the open, it's reversing and turning around. It's really good that. So shakeout demand tails, gap down reversal bars, really good to see. And then here we'll start talking about pyramiding a little bit. So this would be the entry point here as it breaks the descending trend line like this. You can see 1 touch, 2 touch, 3 touch, 4 touch coming through in here. So this would be the entry, but then it also creates this pivot in here. Nice shakeout demand tail the day before and starts taking it out. So here you can pyramid and move the initial stop to cost break even twice the position with the same principal risk. We're going to talk about that in the control and mitigate part of this presentation. Next one. Here is AMD. So this is outside reversals. So remember when I said at the start, there's lots of different various entry techniques? Guess what? There's lots of different various entry techniques. So this one here is an outside reversal. This is a great way to buy pullbacks into key moving averages. Want to see price trade down and then back through the prior day's low. Suggested to not do this if price is extended from the key moving averages. So this is when prices say broken out of the base is in the context of an uptrend and pulls down to a key moving average. So you see here on the left hand chart, we're going to be zooming into it over here. So what does price do? Well, price moves up here and then it starts pulling back. Actually, it starts trying to form this like bull flag pattern. But then do you see the prior closes here? So this bar here, which is the entry bar, it gaps down. So the prior close is here at around about $120. Then it gaps down and this open here may be, say, $119 or so. So it gaps down, moves down, and then as it starts turning back up during the session, the entry is as it takes out the prior day's low with a stop underneath the low of the entry candlestick. In this instance here, the stop would go at 118.13, probably a penny below that, so 118.12, which is circa 1.5% risk, and the entry is as it takes out the prior day's low. So it gaps down, but it's got to be around the 10 EMA and or the 20 EMA, so there can't be air. You'd like to see it kind of pulling down and then reversing. Some people also call this an oops reversal type of entry as well, but that's a way to try and get on the stock that is in a powerful uptrend and potentially you didn't get into it in the base, or you'd like to add to your position. Next one here, reversal candlesticks. So I just want to emphasize the point that large operators, be aware of the game. So you will see shakeout demand tails, but you'll also see, I call them gap down reversal bars. And actually they're a really constructive sign, especially if they're around key moving averages. So you see this bar here, the prior close is going to be up here at just over kind of $84, $85. And then it gaps down, opens around about $80 onto the 21 EMA and then reverses. And then again, it gaps down and reverses. Here, it gaps down and reverses. That is kind of classic games that you will see large operators playing. Large operators also are most active in the first hour and last hour of the session, in particular the first hour of the session. So pay attention. What we're doing is these three bars here where I've pointed to, we've pointed to the blue arrows are pointing to the first candlesticks, okay? So if you look here, we're looking at this third and final one here. The prior close is up here. Then what does price do? It gaps down on the open, but by the end of that bar, it's reversed higher. And look at the volume coming through. Does that look like large operators are distributing or trying to accumulate? Interesting. So be aware of the gap down reversal bars, the shakeout demand tails that you can see in bases before pivots form. They're really good to see. This is then eBay, just to give you another visual example. So be aware in bases of shakeout demand tails. See how this holds the 21 EMA. Remember what we said earlier about reversal extensions, potentially going down to lower time frame. Here you get a gap down reversal bar and strong recovery. And then here you get a shakeout demand tail. Then it moves and then you get your tight pivot here. Then this would actually then be a wedge pop back through. This is eBay back in 1998 and 1999. So be aware of the shakeout demand tails, the gap down reversal bars in developing bases and around key moving averages. Inside bars. So Oliver gives a significant amount of weight to inside bars, and you're going to learn about the wick play as well. So when a bar trades inside the range of the previous day's bar, it's a sign that volatility is contracting. Mark Manvini had a significant influence on Oliver's process as well, as much as William O'Neill to an extent as well. Inside bars can have even greater meaning if they take place on extremely light volume. This is a sign not only is volatility contracting, but trade, i.e. being supply, has completely dried up in anticipation of a future move. Multiple inside bars can amplify this pattern. So to an extent, he does talk about a stop being too tight for too long, but a couple of inside bars in a row in the context of a developing base can be a very, very, very good thing indeed. So see here with Novavax, this is then a descending wedge type pattern here as well, and you see how the lower lows are becoming less and less pronounced in this stock, and see how it then finds support around its 21 EMA, tightens up in here, good reaction to the earnings, and then see how you get this tight inside bar here. Look how the volume dries up, there's not much supply, and then it's a case, as you're going to see in the optimizing profits, he talks about using the 10 EMA and also the 21 EMA to ride the intermediate term trend. As he said, he's an intermediate term trend follower. So inside bars number 2, I'm just going to show you a collection of inside bars with some quotes. Volume dry up precedes move. So see how you get the VCP action, volatility contracts. See how you get this really tight inside bar, the volume dries up, and then the stock explodes out of the base. Another one here with Celsius. Here you actually get back-to-back inside bars. So see how the price pulls back in. So this is kind of a basin break. This would hit. Would be a wedge pop coming down in here. This would be a bit of an extension, but also an EMA crossback, and then it starts tightening back-to-back inside bars. Look how the volume dries up. Look at the relative strength, 52-week highs. Free tool on TradingView. Search my name and you will find it. And as Oliver says here, love, love, love inside bars because it's a way to really manage your risk. So we'll come on to the risk element as well, i.e. you're trying to take minimal risk and maximize the upside. And then look how well the stock trended along its 10 EMA and its 21 EMA here. 101% for it closed below its 21-day EMA. Not bad, right? Especially if your initial stop was underneath the low of that inside bar. Another one, APPS. So see how the stock moves up here and you get a really good reaction to the earnings. This would then be kind of an EMA cross back. There's a little kind of wedge pop coming through in here, but here is the quote unquote basin break. So it's a bit more of kind of your conventional type chart pattern. It's a bit of a flag type pattern forming over here, I suppose you could say, but see how it starts finding support where on its 21-day EMA, and then it moves up and then you get another basin break. Look how tight the stock gets in here. It's another inside bar and the volume dries up. Inside bars really important. Cannot stress that enough. Here, AMD, it looks to be pretty much back-to-back inside bars in the context of a basin break. And what bar is this? Remember, I was teaching it to you on APLS. There were 3 of them on that chart. What bar is this? Gap down, reversal bar. Price gaps down, then reverses, then it tightens up. Understand the games the large operators are playing. Shake out demand tails, gap down, reversal bars. Really key. This one here. Another one, see how it goes, basically pretty much going inside, 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 nearly. It's a very tight range bar. So tight price action invariably precedes moves, as Oliver said. Look how the volume is drying up here. So tightness in price going sideways with the volume is drying up is telling you what about supply and demand? There isn't much supply around. If you're then buying a breakout, guess what? You don't want much supply around before you buy the breakout. Why? Because then you can get some very explosive moves beforehand. Overstock, see how it basically goes tight, 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 pretty much. Inside bar, look how the volume is drying up, then the breakout, and then look at the trend along the 10 EMA and the 21 EMA. So as Oliver said, he's an intermediate term trend follower. So trying to ride the intermediate term trend, combining the 10 EMA and or 21 EMA, but then looking for extensions as well is very key to his process. We'll come on to that a little bit later on. So wick plays, you've probably heard of this. What on earth is a wick play? The trigger is through the high of the wick or the high of the inside bar. I love this pattern. I think it's awesome. You only get it a couple of times a year. It's often in the form of a little flag. The best wick plays are when there's less volatility and tightening. So if you look at Tesla here, what is a wick play? So you see Tesla, this is a daily chart. So see how you get this wick here. So a wick play is an inside bar, but it's even more of an inside bar, if that basically makes sense. So see how you get this wick. I call it a supply shoot, but we can call it a wick here. So the range of that is from 341.56 to the high there at 364.98. And then do you see how you get this bar that trades within the range of the wick? So from 341.56 to 364.98. See how it's trading within this range? So it's an inside bar, but it's an extremely tight inside bar. Then the entry is through the high of the wick bar, the inside bar, and or the high of the wick as well. Oliver's preference, from what I can understand, is actually buying through the high of the actual wick bar, so the inside bar itself. So in this instance would be as it takes out the high here. Volatility contracting, volume drying up are good signs to see. Why? Because it's telling you there ain't much supply coming to the market, which is good. Nvidia, here's another one. So see the range of the wick coming through here. So that is from 244.74 up to 250.90. See this? And then price is trading. So it's an inside bar, but it's a really, really tight inside bar. Even better on this wick bar here. It actually closes on the high of the bar. That's kind of a subtlety. Then the entry is through the high, and then the stop loss is underneath the low. So you can create really asymmetric risk versus reward trades. Here's another one with Zoom. So price is moving up here. It builds what chart pattern? What chart pattern would you call this? It is a bull pennant type pattern because it's actually making higher lows in the base like this. And then do you see how you get this wick? So the wick is from 89.86 roughly to 91.93, and then you get this inside bar trading within the range of the wick. That there is a wick play. So the entry is through the high of the inside bar with a stop loss just underneath the low. So really favorable risk versus reward trade. When a stock closes off the highs of the day, so this is talking about the wick play, so this is UPST, another one. Highs of the day on the previous session, there is a wick play in the daily bar. If the stock gaps higher the next day, it will open potentially in the wick of that previous bar. If the stock stays positive and holds within the wick, it is a sign of strength. So here, okay, you can see here's the wick, here's the inside bar. So the entry is 206.47, I think that is, through the high, and then stop loss just underneath the low. Oftentimes when you drill down the actual wick play bar, so you take it from the daily chart to the 1 hour chart, quite oftentimes you can see really tight, nice price action. And on the 1 hour chart, you can often see it consolidating. This is my own anecdotal experience, is 10 EMA, 21 EMA, and the purple line being the 50 SMA. You can see price clustering around that really, really nicely and nice and tight like this. And look how the volume is drying up there. Just kind of a little subtlety to be bringing in. Then we got one more wick play. So this here is Fastly. So you get a positive reaction to the earnings. Where does it find support? On the 10 EMA. Where does it find support? 10 EMA, 21 EMA, a little shake out demand there. And then do you see how you get this wick play coming through in here? Look how the volume dries up. This one is even better because you've got that larger causality there of this high tight flag pattern with a really positive reaction to the earnings. And then you can see the breakout and then see how it trends here. And then this bar here would actually be your wedge drop in terms of Oliver's terminology. So now we go into the concept of relative strength, and we're going into kind of the MarketSmith charts as well. Remember, they're the video sponsor. If you're interested in a discount and trial, there is a link in the comment section below. So relative strength is extremely important, and it was extremely important for William O'Neill, who had a massive impact, probably the biggest impact on Oliver's trading in terms of what are the types of stocks that he is looking to trade. So some of the text is going to be a little bit heavy, but let me read them out to you because it's really important. So quote from Oliver first, then O'Neill. A fundamental A fundamental truth in my trading is that I believe buying the strongest stocks on a relative basis will lead to the greatest future returns. I want to allocate the money to new leaders that are outperforming the market as quickly as possible. As William O'Neill said, the number one market leader is not the largest company or the one with the most recognized brand name. It's the one with the best quarterly and annual earnings growth, return on equity, profit margins, sales growth, and price action. So this is Zoom here. Okay, Zoom, obviously, was a very big winner in 2020. If you think about why, it is fairly obvious. We were all at home and we needed a way to communicate with each other. Suddenly there was a massive increase in demand for Zoom's products. So people were buying their services, their earnings went up. What do you think happened to the share price? But what's quite interesting is when Zoom's earnings topped out, the share price actually topped at the peak of the earnings cycle, when the earnings coming out on a year basis were quadruple digits. Interesting, we'll come on to that. But Zoom's yearly earnings per share, so EPS, increases over 5,000% over 2 years. So for here, 2019 they reported for the year 6 cents, but in 2021 they reported $3.34. That's a 5,000% increase. Look at the move Zoom had. It goes from basically $60 to $600. Really interesting. And then you see here that the earnings that were coming out at the top here were 999%. That's quadruple digits back to back, and that's when the stock topped out. So yes, it's very important to look for the stocks that have huge earnings, huge sales growth, but this is where the contextual framework comes in, and thinking about extensions. So the various extensions, first extension, second extension, the third extension, how many bases have you seen in the context of the upcycle, understanding phase 1 into phase 2 uptrends, phase 3 distributional tops, and then price getting a little bit more wide and loose, bit more volatile, high volume indicates more so distribution. So that kind of framework at the beginning, kind of very similar to the Wyckoff price cycle or Stan Weinstein stage analysis, is really good for thinking about things like growth stocks. Now what I want to do is just show you some examples of relative strength. So in 2003, my understanding is William O'Neill basically owned one stock, and it was eBay. And if you think about eBay from a CanSlim perspective, and you think about the technical strength and the relative strength, you can kind of see why as well, right? So you see eBay here. I'm only going to go in depth for eBay. I may do a couple of others, but you see how eBay actually makes its low here in late 2000. Okay, it actually bottoms in 2000. Whereas what does the market do? The market continues making a series of lower lows. What does eBay do? eBay puts in a series of higher lows. So eBay is making higher low structure on the weekly chart, while the NASDAQ composite is putting in lower lows, which is stronger technically. It's eBay, isn't it? It's putting in higher lows. You can see this in the RS line. Again, it's free to use. Search my name on TradingView, the indicators. You will find it. It's really, really helpful. You can just pin it to the bottom of your charts like this. You get blue dots for 52-week highs and red dots for 52-week lows. So leaders will often bottom first, but then they will also, leaders will often top first, but they'll also bottom first as well. Then it starts tightening up here. So just as the market starts coming off of its lows, that's when eBay starts ripping. That is the proverbial basketball being held underneath water by the market. Okay, the stock being the basketball, the market being the kind of water pressing it down like this. So when that pressure is lifted, what does the stock do? Pops up, starts trending. So focus on the relative strength, the really strong ones. Here's Tesla. We spoke about this holding the 200. So, well, this is the 200, but it's the 40-week on this chart. These are weekly charts. And then you get this cup and handles. This would then be kind of be a base and break coming through in here. But look at the relative strength of Tesla versus the market. The market is trending below all these key moving averages. Tesla was able to hold its 40-week, which is its 200 SMA. Then we take a look at PHM. This is back in 1980s. So see how the market is actually putting in a lower low after this stock breaks out, and this stock goes up 800%. Look at the 52-week highs. Relative strength, relative strength, relative strength. Amgen had some fantastic moves. Look at it in the 1990s. Amgen is just trending up here, making higher highs and higher lows, while the index is making lower lows. This is an extreme example of relative strength. Another one for Amgen. See how it's building its pivot here above all the key moving averages, whereas the index is below 3 out of 4 of the key moving averages. This is the relative strength point. Here again, this is NXGN, stock you probably never heard of, but look what it was doing. Higher high, higher low, higher high, higher low, higher high, higher lows, tightening up in here. What's the index doing? Lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. This is the relative strength point. Focus on the relative strength that tick the CanSlim criteria. The importance of volume. So we're looking at this Fastly chart again with the wick play and then the breakout thereafter. If you see enormous relative volume relative to the typical amount of trading in a stock, it's a sign of institutional buying. I call heavy volume signature bull snorts. As a smaller investor, we want to find the stocks institutions are building positions in with the goal of riding their coattails for large gains. Therefore, when we see huge volume, it's a sign to pay attention and search for a low risk entry. So oftentimes you can see the huge volume, a bull snort as Oliver calls it, around the earnings as well. He also has another very good saying that gap up means the street is caught off guard. I'll repeat that. Gap up means the street is caught off guard. So oftentimes around earnings, suddenly the company could have a blowout earnings report and the street is caught off guard. The analysts were expecting this and suddenly this came in and it's massively exceeded their expectations. So now suddenly institutions are getting in there trying to build positions because something has fundamentally changed with this company. And usually if a company has one significant beat, it usually means subsequent significant beats as well. So seeing these kind of post earnings bases build are really good to see, and there's the wick play coming through in there. So the big theme as well, so Oliver will think about themes. He'll try and understand what is the theme in the market or various themes in the market. So many long-term holders are buying a vision of the future. Think about Tesla here as well. In the vision, if the vision of the future is powerful enough, you'll have more people interested in buying the stocks. Having a powerful story can inspire conviction to hold the stock through pullbacks and uptrend. I think Oliver there is referring to both himself, but also to others as well. So if you think about some of the themes of late, you have EV and green energy, Tesla, the at-home gym being Peloton, work from home, Zooms, e-commerce, Etsy, Pin, Shopify, Cloud Edge, Fastly, Net, gig workers, Fiverr and Upwork coming through as well. So trying to identify what are potentially the 3 to 5 themes going on in the market and 3 to 5 groups as well. At any one time in the market, my experience is there's usually somewhere between 3 to 5 groups and or themes that are leading. So okay, what are the leading groups? What are the leading themes? And then what are the leading stocks within those? Thinking about it more so from a CAN/SLIM perspective. So i.e. liquidity, but then massive earnings, massive sales, massive estimates coming through. Have you seen really positive reactions to earnings like this? Is the stock basing? Is it showing relative strength? So on and so forth, right? So sales growth. Many studies show that sales growth is actually the greatest predictor of future stock appreciation. Revenue growth is a key metric for finding big leaders. So this was on, and actually it had earnings come out, which were, again, this is why you really want to focus on the earnings. So the prior earnings report, fantastic reaction, but the most recent one at the time of filming this is May 2023. It reported around about a week or so ago. It reported huge earnings, huge sales, and the stock got absolutely walloped. So there is no guarantee that, if you find a company with big earnings and big sales, it's just going to keep going to the moon. Absolutely not. But here you can see on at the time of taking a print screen, huge sales coming through, huge earnings coming through. Look at the estimates coming through, guidance up as well. So looking for the sales growth, and what Oliver's saying here is he's actually putting a greater weight on high sales growth relative to high earnings growth coming through. It's my kind of interpretation of that. But earnings growth is extremely important. I'm not discounting that at all. So this one here, there's a reason why companies get to the size of Microsoft, Amazon, Apple, and Google. There's a Warren Buffett quote, and I think it's something like, in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. And what does Buffett mean by weighing machine? He means its earnings. In the end, the company will be judged by its earnings. Sure, you can get some kind of voting that suddenly, and this is kind of Oliver's point about themes and stuff like this, people can get a little bit carried away with themselves and things like this. But at the end of the day, if the earnings are not there, the company is not going to grow into $1 trillion market cap. Okay, the Microsofts, the Amazons, the Apples, the Googles of the world. Tesla at one point as well was over $1 trillion market cap. But here you go. If you look at Microsoft and you look at the last 8 years in terms of the earnings per share, see how it's just going up. Institutions absolutely love this. $2, $3, $4, $5, $7, $9, $11, estimates are up, sales are growing, and again, Microsoft is now absolutely massive, but sales are still growing steadily for a company the size of this as well. Earnings generally are growing as well. That is how a stock gets to the size of a Microsoft and Amazon and Apple or Google. They need the earnings there and the consistent earnings there over many years, many decades to get to that size. So this is then an interesting one. So this is Monster Beverage. So this is just a chart to kind of illustrate and try and bring through a couple of things together of the power of both technicals, but then also bringing in the fundamentals as well. So if you can find a stock that is setting up technically, so Monster Beverage here, this is actually on the monthly chart. Oliver does put a significant amount of weight on the monthly chart. I haven't included too many here. This is the only monthly chart you're going to see in this presentation for brevity's sake, but see how it starts building the higher lows. You get these shakeout demand tails, then you get the extreme tightness. Remember what he said about price, where volatility dries up, invariably precedes moves. So here you get the volatility dry up on the monthly chart and then the exposure. But take a look here, the earnings grow year over year, the sales grow year over year, and the margins accelerate as well. So you have a company growing its earnings, its sales significantly, and also significantly improving their net profit margins. And you have a really good technical setup here, and look at all the 52-week highs. So if you can line up the technicals plus the fundamentals in terms of earnings, sales, and improving margins in a very strong theme as well, you know, have a very strong situation on your hands. Trade what you know. So Peter Lynch also had a big impact on Oliver's strategy. So I'm a huge believer in the Peter Lynch buy what you know approach. If you can find a strong stock with big earnings and sales, relative strength, a strong new theme, and you understand it, that is the ultimate combination of a top idea. So here you can see this is Duolingo. So it's currently ranked in the number one group. The company's gone from losing money to expected to being profitable in 2023. A little bugbear here is 2024. The earnings estimates are actually down over in terms of versus 2023, but the guidance is up. But look at the consistent sales coming through here. So this is in millions, going from 58 million to 81 million to 96 million to 115 million. High quality funds in there, high RS rating, relatively new in terms of its IPO and past the lockout period as well, building a big phase 1 base, and now this kind of phase 2 continuation type base potentially building there as well. Oliver's looking more so for high beta and liquid stocks. I know many of you will be familiar with average daily range percentages as well, so you can look for a high ADR stock. You can also look at the beta of a stock as well. So if you think about beta, if this here says 1, it basically means if the S&P 500 moves 10% in either direction, the stock will move 10% in either direction. If the beta was 2, if the stock went down 10% or up 10%, the stock would be, the move would be double that. So if the market goes down 10%, it's reasonable to expect the stock would go down 20% rather than 10%, and if the market went up 10%, it'd be reasonable to expect the stock went up 20%. So it's basically 2 times. So ideally Oliver is looking for high beta, so stocks that are going to move, and they're also liquid as well. So I prefer to trade very liquid stocks as they have more defined price movements. Getting in and out of a stock with very little slippage is important. Usually I prefer stocks that trade 1 million shares per day or more, but it's more about how the stocks move, as price action should feel uniform. I get a feel that a stock is acting correctly, and if it isn't, then I don't trade it. You want higher beta stocks so that when you do catch on to a strong trend, it has the potential to move quickly in a short period of time. So if we take a look here, this is ACLS, it's a ticker, it's a semiconductor stock, good sales, good earnings, good estimates, forward guidance up, decent beta as well, RS rating very strong, finding support, has kind of undercut and reclaimed its 10-week being this red line here. Some high quality funds are in there as well. Mid-cap name, kind of $4.1 billion, so not the most liquid of stocks, but certainly takes a lot of the can slim criteria. Was a good stock to show, and you can see ROE, return on equity, 30%. O'Neill put a significant emphasis on that. Earnings per share growth, 41% over the last 3 to 5 years, and not too many shares outstanding as well, 33 million, so it does mean the float can turn over a little bit quicker. Avoid penny stocks. You can make a ton of money in penny stocks if you are right. You can also lose a lot if you are wrong. My number one goal is to protect my principal capital. I do not trade stocks under $10, and the stocks I usually trade are well over $50 per share. Many institutions have rules that do not allow them to buy stocks below a certain share price or market cap, and I want institutional sponsorship. So I thought this one here was of Zom was a fairly good one to see. This is kind of the life of a penny stock, isn't it? You can see absolute huge moves here, and then just nothing. So kind of just extremely volatile, very liquid, very erratic. So the price movements are not uniform like you would see in, say, the Zooms, the Pelotons, the Shopifys, the Teslas, the AMDs, the Nvidias of the world, the Fastleys of the world as well, that Oliver is more so looking to trade to avoid penny stocks. I think he made that bit there pretty clear. So now we're moving into a different section, which is also going to bring in the identify part, but we're going into the control and mitigate slides as well. So this one here is going to be a little bit text heavy, this slide, but then we're going to go and start getting into some examples, so you'll really start understanding how is Oliver thinking about controlling risk and mitigating risk. So I'm a trader, and my goal, I don't know why I did that in capitals, is to control the risk reward equation. Stop losses allow you to control the risk reward equation. So Oliver thinks about stop losses, that there are 3 different types of stop losses. You have your initial stop loss, which determine initial principal risk and position size. You have your rising stop loss, which you use to protect open profits. And then you have your final stop loss, which is exiting the position potentially after the stock has been trending. Stop losses move up, but never down. Stop losses move up, but never down. And with that, if your reason for buying is no longer there, you shouldn't be in a position anymore. I've got a slide on a breakout, so a stock that's breaking out of a base on earnings and then pulls in to emphasize that point. Work out your initial max pain stop, usually below the pivot and or key moving averages. Then the stop should be moved to the breakout day low when it is a good breakout bar and or action through the pivot. Then we want to try and get our stop to break even as quickly as we can without choking that position off. You do need to give your stocks a bit of room. You don't want to move your stops to break even too quickly, or you might lose your position. In general, I'm comfortable using tighter stops. I would generally say my stops are between 1 to 3%. There are times when I'm taking a 5% stop, but I'm likely taking a smaller position. 1 to 3% initial stop loss is fairly accurate for about 90% of my trades. Most of my winners work right from the start. So remember, Oliver in essence is a momentum breakout trader, then trying to ride the intermediate term trend. So he's trying to enter when he thinks the momentum is coming in. So what he's saying is most of my winners, they're just going immediately when he is entering through the pivot. It's not uncommon for me to take a couple of paper stocks, so stopped out, then get it right when he's trying to get positioned in a stock. So let's start talking about a couple of variations. So as soon as we can, within reason, we want to get our stop to break even to protect our principal. So imagine here we get this kind of VCP flag type pattern building here. So the pivot's going to be at 50, so it goes up, pulls back down to 40, bounces, puts in a higher low here, bounces back up to $50, pulls back down, puts in this low at $48. So Oliver's entry can be in here at $50 with a max pain stop at $48. So $2 underneath the low of this final contraction, and imagine if that tied in with say the 10 EMA as well. But as it starts breaking out, potentially you could get a really nice breakout day. Then Oliver would move his stop to the low of the breakout day. That may also coincide with the break even level. It depends. Let me show you a couple of examples. So here, when a stock puts in a strong breakout, especially if there is heavy volume, the stop should be put at the low of the day. If the low of that day is violated, it's a sign that sellers have overpowered heavy volume that caused the initial breakout. So imagine on this one here, okay? See how it starts tightening up? You get kind of 1 contraction, 2 contraction, and this little low pivot. Look how the volume dries up. And then it starts moving through here, which is also a wedge. Pop, you got it. So as this starts breaking out, what Oliver's then saying is, well, if I had my initial stop, say down here, there's now no point. I can actually just move it to the breakout low of the day because it shouldn't fail. It's such a powerful breakout. If it fails and turns around, something is inherently wrong with this stop. So what Oliver's saying is his initial stop maybe say here, or in this instance here, this is nice because you get this inside bar and it's a flag type pattern here. See, it just surfs, just rides to 10 EMA. Look how the volume dries up on this bar here as well with this inside bar, then it goes. So if his initial stop was say underneath the low of the inside bar, or maybe it was just underneath the low of the prior 2 days, when it starts going, he's then moving his stop to break even. Sorry, the low of the breakout day, and then when it starts kind of following through, assuming it's prudent, that's when he's then moving up to around about break even. So he's initially controlling the risk, but then his risk mitigation is actually moving his stop up as well. First place is usually low of the breakout day, then it would be the break even point. Hopefully that's making sense. And then there's a good one here, high volume breakout. So if his initial stop was say here underneath the 10 EMA, well, when this starts going, if he was buying through this pivot here, and then he moves his stop here to the low of the breakout day, his stop's not quite at break even. Maybe it's kind of I don't know, $1 away or something like that, a percent to kind of 2% away. But then as it starts moving out, that's when he could go lower the breakout day to then pushing up there. Got some examples. Hopefully it'll make sense a little bit later. So control, thinking about risk versus reward. So we've determined the setup. Does the potential upside justify the risk? If I have to take a 10% stop to make 20%, that's not a trade I have any interest in. But if I can think I can risk 3% to make 30, 40, 50, and maybe even 100%, that's a great opportunity. At a minimum, I think you should be targeting potential reward to risk of 3 to 5 to 1. So what he's saying there is, if we look at this example here, what he's saying is risking 1 unit, but how many units can we potentially make from a trade like this? Well, in this instance here, say before it closes closes below whatever moving average this is 1, 2, 3, 4, 5, 6, 7, 8 times the initial risk. So he's looking for where he can take minimal risk but have lots and lots of upside, and then the optimizing profits part that we're going to come into a little bit later helps him stay in the trend to optimize the profits, as the name implies. So small losses, big winners, small losses, big winners, as we did on the first quote. For me, I'll have a couple of trades per year which make my year that can be 20, 30 R. To be frank, many of my other trades are kind of mush, break even. This is the 80-20 principle. So what he's saying there is a couple of trades per year actually make the vast majority of his profits for the year. So this is also the patience element of waiting for the bigger one to come around and then managing it correctly as well. Okay, so what he's saying here is he'll have a couple of trades per year where they basically make his year where he has huge multiples of his initial risk, and he can potentially pyramid into them. We're going to talk about pyramiding a little bit later. So take small losses, and though sometimes it takes multiple attempts to get on board a stock. That's the paper cut point that we did a couple of slides ago. Next slide. So this is thinking about control and mitigate, so entering and exiting. This one is a little bit text heavy, but it really explains how Oliver goes about pyramiding. So a key to risk management is buying in pieces and selling in pieces. Overall, the goal is to tighten your stops as your position size increases. You use initial profits to increase your size while maintaining or even reducing the principal capital at risk by raising stops. This is a Minervini point about using profits to finance future risk. So I'll talk about this example in a minute, because the text is here to describe it. I'm really good at adding to positions in the sense of I'm not afraid to add. I don't have the highest hit rate, but when I get a stock right, I usually get it right. I usually get it pretty right, so i.e. a big winner. So thinking about big multiples coming in, I would say I can make the majority of my money on a whole year on like 3 to 5 trades when I get this right. This is my real edge. Remember kind of the 80-20 principle, but kind of maybe kind of 90-10 principle here, that it's a couple of trades a year, kind of a handful, that really make Oliver's year. For example, let's say you bought 100 shares at $50. So here we're doing this example. So you buy 100 shares at $50 with a stop, with a $2 stop and $200 of risk. So here is the stop loss, $2 stop loss at 48. The stock advances to $55. So up here, advances to $55, pulls back to 53 and presents a new buy area at $55. So this is kind of, imagine that this was say like a flag or a little continuation type pattern here. You add an additional 100 shares at $55, okay, in here, and adjust the stop to $53 on the entire position. So we're moving the stop loss where we bought the first batch of shares up here. So we're actually locking in some profit. I will just read the whole thing, then I'll go through it. So you add an additional 100 shares at $55 and adjust the stop to $53 on the entire position. Your total risk is actually a $100 profit, in that you are using the $3 profit from the initial entry, assuming you get stopped out at $53, to pay for the additional 100 shares of risk. Despite having double the position size and double the potential profit if the trade works, you have less principal risk. When these type of scenarios play out in your favor, you have the opportunity to have a large position that can really move the account if the trade works. So here's the maths on this example that we're doing here. So your original 100 shares bought at $50 and then the stop loss at 53 means you're locking in $300 of profit. You're buying an additional 100 shares at $55 here with a stop loss at 53. So they would have $2 of risk associated per share, which is $200 risk. So your $300 locked in profit minus your $200 new risk equals $100 profit, while doubling your position size. This is a really key point to understand how Oliver is pyramiding in, but he's pyramiding in higher, adjusting his stop loss up. So he's increasing his position size and getting concentrated on what he thinks are kind of the TML type stocks. And we're going to go on to portfolio construction in a little bit, but this is the pyramiding point, and he talks about having top ideas where he's trying to get the bulk of his account in a couple of stocks, especially when on margin. So we'll do a couple of those in terms of thinking about position sizing and how he manages his accounts a little bit later on, how much of his capital he's allocating to different kind of ideas in his account. So adding and mitigating risk. So we're going to do this one here. So see how it's breaking out? It's fairly wide and loose, this base, okay, but it powers up here and then it starts building this flag type pattern here and consolidating underneath this downwards trend line that you get 3 touch points on here. So it's a bit of a kind of descending channel, very volatile descending wedge type pattern. But see how it powers up here, and then it goes back to back inside bars. So the entry could be through the high of this inside bar here with the initial stop loss placed here. Then it powers out and it creates another little pivot here. It's nearly an inside bar. It's nearly kind of back to back inside bars, but it tightens. Look how the volume dries up. So the add could then be here, but then you're pushing up your stop loss in the entire position underneath these lows. So you're then locking in a profit on your previous shares or your initial shares to then finance the risk on your next shares. So you're actually kind of backstopping a profit in here. So remember this example here where it kind of breaks out, pulls back, and then you see a higher pivot, so you can move your stop loss up but then increase your position size. See this, how it breaks out, pulls back, and then goes. That there is how that is basically playing out in a visual example like that. Hopefully it makes sense. Here's thinking about one. So as the stock is moving higher during its trend, the stop is adjusted higher at key points. These key points can be reconfirmation, so basically where it's making the trend is making higher highs and higher lows, ignite bars, which we'll talk about, and important key moving averages and or stop losses. So what I've just tried to do here is show you an example of Tesla, how Oliver is thinking about moving his stop loss up. So we're talking a little bit about the optimizing profits here as well, but I'll give you kind of guidelines on that and quotes as we get to that section. So imagine that the initial entry is here. Okay, the entry is here at this breakout, and let's say the initial stop loss is placed here, okay, I, and then we're going to talk about the R's and then the F as well for the stop losses. So the entry is here, and I is going to be our initial stop down here underneath this pivot, and let's say it's underneath the 10 EMA as well, being the black line. Okay, as the stock starts powering out here, well, we may want to move our stop to say the low of the breakout day. So after the first couple of days, we could move it to say the low of the breakout day. So we're mitigating risk by pushing our stop loss up and reducing the risk we got on the trade. Then it starts getting out hits, and then we probably moved it to around about break even. So imagine there's like another an R2.5 in here, right? And then there's an add point. It kind of pulls down for a couple of days, really tight bar. So imagine if there's an add point here and it starts powering out. This is also breakout reconfirmation. So it's powering out. I call this bullish synchronicity. Widespread candlesticks, opens on the low, pushes up. Look at the volume coming through as well. Really, really, really good to see. It's also a bit of an ignite bar as well. Now, ignite bars are basically widespread candlesticks on high relative volume. I call them bullish synchronicity. Oliver calls them ignite bars. They're basically the same things. It's where there's a lot of demand moving into the stock and very positive price action, and it's really standing out like a sore thumb. It's indicating there is a lot of demand for this stock. Now, the lows of those kind of ignite bars should not be lost. So here, as it starts powering higher and making a higher high, this is where the stop loss could be moved from R2 to R3, and you've also added to the position. Then it starts powering up. Then you get another ignite bar. So you wouldn't want to see the lows of that bar taken out. Great, move the stop loss to the low of the bar. Then it builds this little flag type pattern, which is also what? It's also a wick play, isn't it? See the wick play coming through in here? So then there's an add through here. So you could then push your stop loss up even higher underneath, say, the lows in here. And then you get another ignite bar. So then you could move it from R4 to R5. But to be fair, you probably moved it up in here, maybe underneath these lows. And then as it starts rolling back over, you get a pullback to the 10 EMA, so then you could adjust your stop loss here. On this day here, there was a bit of news as well for those of you that know Tesla. Elon Musk actually did a poll about should he sell. I think he was looking to sell around about $5 billion of his Tesla stock to pay a rather big tax bill. And then here is where Elon started selling. So there was a little bit of news around here as well, but price obviously extended here. But we will talk about exhaustion extensions and optimizing the profits. I'm going to jump a little bit ahead just to make the point here. For me, I think in terms of optimizing profits, and you guys can go and study this, and we're going to do a deliberate practice session at the end of this video. For me, instead of trying to guess where the top of the stock is, I've just found it's better to go lower the bar, lower the bar, lower the bar. For me, I think it's a much more consistent and rules-based strategy. Oliver doesn't talk about that, but for me, from studying tens of thousands of these, I think lower the bar, lower the bar, lower the bar is much more effective than randomly kind of thinking, oh, I think it's extended here, I'm going to sell. Well, you may think it's extended here, and then you missed out on another kind of $100 worth of upside. But if you just went, if you start thinking it gets extended, lower the bar, 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 you're taken out up here somewhere. So for me, I just think the most consistent and rules-based approach, and we'll talk about this in the optimizing profits phase and those different examples, is lower the day, lower the day, lower the day, lower the bar, lower the bar, lower the bar. That's just for me, little kind of side point there. So here we go. This one is a little bit text heavy, isn't it? So has to be though, because we're talking about position sizing and also portfolio construction. So the way my account is put together is not always the exact same, but over time I generally hold 8 to 12 names, and you should have a very good idea of what those 8 to 12 names are. Now Oliver splits those into thinking about different kind of ideas he has and then weighting them differently as well. So top idea, I usually have 2 to 3 top ideas where I know the story, feel the theme is excellent, and the name is near the beginning of its trend. I want these ideas to be breaking out of larger basing patterns and to show the volume from the get-go for a sustained move. So basically breaking out of a really large phase 1 base, showing relative strength, ticking all the cancel criteria. Then he has a conviction core idea. A conviction core idea is a high conviction name that fits all the criteria of my top ideas but doesn't quite fit into the absolute best breed column. It might fit into positions 4 through 7 in my account. Volatile conviction core idea. This is a conviction core idea, but the stock may have higher volatility, could potentially be less liquid as well. So I want to position size down to account for that. If it still fits in the position, it still fits in the position 4 through 7 bucket, but has a smaller account weighting. I judge the volatility based on how the stock trades and my interpretation of its movement. Some people use things like average true range, ATR, as a measure of volatility. I'm not that scientific. Core name. This is a name I want to have my top 7 to 8 holdings and plan to hold it for a sustained move, but for some reason it is second tier relative to my top holdings. Swing position, stocks and uptrends not coming out of a large basing pattern. I may take positions on shorter patterns such as the bull flags, pullbacks to moving averages, bull pennants. So some of those much shorter patterns we've been looking at in the context of an uptrend, so like 3-4 day pullbacks, maybe 5 day pullbacks into key moving averages. So it could be outside reversals, could be, as Oliver was saying there, the flag type patterns as well. Could be a wick play as well. Given the short pattern, I expect a shorter term trade and plan to book the profits on these trades more quickly. Overall portfolio approach, I trade with margin and I like to get my I like to top weight my top 3 to 7 ideas and diversify the back of my portfolio as I start to put on margin. Additionally, I view my top holdings as higher conviction plays that I'm going to be more interested in holding through pullbacks. The back half of my portfolio are my cash flow names where I want to be more aggressive in booking profits on extensions from the 10 EMA to keep the account moving. So here you can see, I won't read it all out to you. You've probably been reading this. Okay, but this is giving you an idea of a margin approach and a non-margin approach and how much Oliver is looking to put in. So this is not risk, okay? This is not his kind of risk, as we touched on earlier. He's risking somewhere between 1% and 3% of his total account on, sorry, not on the total account. He is risking between 1% and 3% in terms of a stop loss, okay? So what I'm saying here in terms of the top idea, he's not risking 25% of his account on his top idea stock, okay? He's got a stop loss somewhere in the region of 1% to 3%, still most likely on that top idea stock, okay? So this is not how much risk. He's not risking 35% of his account in a top idea. He'll still be going in with a tight initial stop, but somewhere between 1% and 3%, so keeping it really, really tight. Hopefully that made sense. I explained that little point there a little bit badly, but hopefully I kind of pieced it together a little bit there. So control. This is an interesting takeaway. So is your reason for buying still valid? So if Oliver's buying a breakout and the stock's not breaking out, well, his reason is invalid. It's not valid. So this is one that I could find here. It's a relatively recent one. OSUR is the ticker. So you can see it's building this kind of a flat base type pattern. Maybe it's a bit of VCP, but I'd say it's a kind of Davis box, isn't it? Just kind of riding the 10 and 21 EMA. And then it's an earnings based breakout. And there was a big beat. You can see the surprise coming through on the earnings. You can see the surprise on the revenue as well. So imagine if you were buying this breakout coming through in here. Well, and imagine if your initial stop was, say, underneath the low of this bar. So think about what we were talking about with the controlling risk and risk mitigation. So if you're going to buy it, say here through this trend line, and let's just say that's $7.10, and you're going to place a stop at $6.80, so around about 30 cents. Well, as it starts breaking out and you can see the supply prices going up on that day, well, you could move your stop from $6.80 to the low of the breakout bar, so just over kind of $7, $7.05, something like that, because your expectation is this should just now go. It's starting to go. It's on the earnings. This is the catalyst. It should just power at par. So why do I need to keep my stop loss down here? I don't. We can mitigate risk. We can move it up. And then when this bar comes, obviously you'd then be stopped out here. But this is a point of the kind of initial max pain stop, but then raising your stops. So breakout low of the day makes sense because it's now going on the earnings. So if you buy a stock for a specific reason and that reason is no longer true, then your reason for being in the trade is now invalid. Basically, if you buy a stock for a specific reason, that should say, you should sell if that reason is violated. So if you're buying an earnings based breakout and then it's not breaking out on earnings, it's invalid. What's Oliver telling you to do? Exit. So reconfirming price strength. Now I've drawn this schematic perfectly. It rarely plays out like this, okay? So this is basically, you guys can read this, I will just summarize it here. This is basically a play on a Darvis box. So what Oliver's saying is you have your kind of initial base entry here in the stocks respecting the key moving averages. So you have your first stop, your second stop, your third stop, your fourth stop, and then you're stopped out here, okay? What Oliver's basically saying is as you make higher highs and higher lows, when the higher high is then taken out by a new higher high, raise your stop up. So see how price comes here, it makes a higher high, higher low, and then here at this raised stop point is making a higher high. So this is where you could then raise your stop loss from here to here. So then you're putting it underneath the higher low, which could also coincide with being underneath one or more key moving averages, whatever moving average we're imagining this is. So it's a 10 EMA or the 20 EMA, something like this. So then price goes again, makes a higher high, higher low. As it takes out this higher high, makes a new higher high, we could raise our stop loss again. It rarely works out as perfectly as I've shown you on this schematic. I actually think using moving averages as trailing stops, which you're going to find Oliver speaks about in the optimizing profits, is easier. You could also think about trend lines as well, and I've got a slide on trend lines a little bit later, but we are in the optimizing profits phase now. So 1021 EMA trailing stop. Sell when a stock closes below the 10 and or 21 EMA. Which specific EMA is open to interpretation based on whatever moving average the stock is showing respect for during its move higher. As a trend extends, price may accelerate and it may be worth moving to a shorter moving average. If it's a bigger cap stock like a Tesla or an Nvidia or an AMD, it may be more prudent to use the 20 EMA or the 10 EMA, and or you do what I do, I use par. So I will sell par, it depends if it's extended, but I will look to free roll my trade early on, and then I will try and ride the 10 EMA and the 20 and the 21 EMA for me, and I will sell par on a close below the 10 EMA and par on a close below the 21 EMA, but it depends if price gets extended. And remember what I was saying about lower the day, lower the day, lower the day. If I start thinking price gets extended from the 10 EMA, I will go lower the day, lower the day, lower the day, lower the day, start checking off, maybe on all, maybe on par, depends how extended it is. Personally, I said here, if I think the stock gets extended from the 10 EMA, I will start checking off low the day, low the day, low the day. Up here, the stock is absolutely extended and it's gone parabolic and huge climactic volume coming through. So at least I'd be going lower the bar, okay? Lower the bar. Extended stocks can become more extended, but even here, imagine if you actually bought this, say, off the 10 EMA here or 10 EMA here, and you think, oh, crikey, this is extended here. Well, if you just go lower the day, you're just choking it off. As Darvis said, who has a very big impact on Oliver's strategy, let your stop loss decide. Okay, so 10 EMA, 20 EMA, really, really, really important as reference guide, as the quote says down here. You could also have rising trend line breaks, and the rising trend line will invariably match up with the 20 EMA or 21 EMA. Usually they're pretty close, but it needs 3 touch points, okay? Touch point 1, touch point 2, touch point 3. So it breaks the trend line here, loses it, and in this instance loses the 20 EMA as well. You can read this quote in your own time, and then that there would be the exit. Going up on another one, gap up exhaustion extensions. So when a stock gets extended into its trend, gets extended from the 10-day EMA and has a large gap up, this can often be a time to sell or at least partially sell a portion of your position. Selling and exhaustion is selling into strength. Again, look how effective lower the day for your stops would have been during the extension. So you see here with Tesla, imagine if this bar here, okay, this gap up doji, you thought, oh, this is really extended. For me, I know this is a presentation about Oliver, but I want to put kind of my own spin on it, my own experience. Lower the bar, lower the bar, lower the bar. I just think as a rules-based thing, it's just much more effective for me. I prefer being rules-based like that. So lower the day, lower the day, lower the day, really effective way. But you have got to understand the stock and understand when it is potentially extended and climactic and extended from the 10 EMA. So this here would then be the extension, the exhaustion extension, okay? Hopefully that there is making sense, but trying to stay in for the intermediate term trend and trying to ride it. The ignition bar low, we touched on this a little bit earlier. An ignition bar is some sort of wide range bar or heavy volume continuation bar. They should be noted, and those daily lows of the ignition bar should not be violated. Therefore, when we see an ignition bar low, we want to adjust our stops to lower that bar. So you see here, Tesla starts powering out, ignition bar, ignite bar, lower the bar here, especially if it's on earnings. That there is a bigger catalyst as well. I think that has much more weight to it. And then there is that wick play that we were talking about earlier on. So be on the lookout for those ignition bars in the context of a trend. Widespread candlesticks, really positive price action. They should stand out like a sore thumb on the chart, and look at the high relative volume confirming it as well. Sell some, hold some. So this is kind of like a mental approach. Those of you who have read Minervini's book will know his kind of concept of selling half. It's kind of a win-win. So this is a similar take on that, I think. Sell some, hold some. So risk reward selling guidelines. Sell 1/4 to 1/2 of your position within the first 3 to 5 days after a breakout at 3 to 5 times your initial risk. As the trend progresses, reduce if you see red flags and or signs of distribution. So that could be wedge drops, it could be bearish synchronicity bars, it could be kind of gap up bars that are then fading, everything we've been covering. Sell the final piece into an extreme extension or get stopped out on weakness if price loses a rising trend line and or 10-21 EMAs. Remember, Oliver's saying use whichever moving average works best for the stock, what the stock has respected. Sell margin into strength and equity into weakness. Sell some, hold some. So here is just a visual example of that. Stock trading is all about selling at a multiple of your risk over and over again. Let's say you risk $2 on your trade and have a $10 gain and the stock is a little bit extended. It's reasonable to sell some, hold some, because you have gained 5x your initial risk. This concept may help you hold a core position for a larger move. It also allows you to have far more losers than winners as gains are a multiple of losses. So let's imagine here you get a kind of bit of VCP type action going on, tightens up here, you get an inside bar coming through, so your entry is here, 3 to 5 days later, sell some, okay? Sell some here at a multiple of your risk, and then you see you get this pullback in here. There's actually then this bull flag type pattern forming here. This is then like an EMA crossback, isn't it? First test into the key moving averages. Then this here would actually be a base and break, so potentially you're adding in here. You're potentially adding through here on this little tight inside bar where the volume dries up as well. But the point of this chart is when it then closes below, say, the 10 EMA, sell part of your position, and when it closes below the 20 EMA, which is the 21 EMA on my chart, sell another part of your position. So that's how I kind of trade, much more so, is selling part early on to free roll the trade. I'll cover that in other videos, and then trying to ride the intermediate term trends, being the 10 EMA and the 21 EMA, and selling part on a close below the 10, part on a close below the 21. But if I think it gets extended from the 10, potentially choking it off, all of the position, part of the position, depends how extended and kind of climactic the move is. Now we're going to go into the mindset a little bit. So talking about early on envisioning trading for a prop firm, I went to sit on their desk multiple times and created a vision of my head of massive success. So I think this is really interesting. Before Oliver became very successful, he was creating a vision of him being successful in his head. Now many of you will be familiar with kind of the law of attraction and things like this. Joe Dispenza's work is very, very interesting in terms of your personality creates your personal reality. I really love that saying. Your personality creates your personal reality. So here you can see Oliver was actually talking about he created a vision of himself becoming massively successful at stock trading. And you'd say that played out. Flexibility when wrong and patience when right are also key factors of outperformance. These skills are created through hard work and time. The learning and growing never stops. And then these are some here. Some old sayings with a lot of meaning for Oliver. You've probably read them already, so I will not take you through reading those, but you'll be very familiar with many of them. Deliberate practice. So I'm going to show you this slide, and then we're going to go into that chart. Remember, around about an hour and 50 minutes ago at the start of this presentation, I showed you that chart of UPST, and I said, where are the entry points? Where is the wick play? Where is the bull flag? Where are the wedge drops? Where is the base and break? Remember that chart? I'll show you after this slide. So deliberate practice. How on earth did Oliver get so good at trading, right? How did he do it? Well, here you go. There's an art to this for sure. I've looked at a lot of charts and I've lost a lot of money while learning how to spot these setups. There's a creativity factor to how you look at charts. I don't care what anybody says. The more you practice, the more you put into it, and the more charts you look at, you're going to get better at being able to identify different patterns. So much of trading is basically pattern recognitions or pattern recognition skills and having a very good understanding of risk management and trying to ride trends. Go through all the biggest winners of last year and go through the names that worked this year and trade them. In terms of bar by bar stuff, we'll come on to it. I set up my chart where I can see the bar before the entry and mentally trade the stocks that have already had their moves. It's not perfect because I kind of know what's already happened, but I try to be honest with myself for how I'd execute my rules and take it bar by bar, and I mentally trade them after a fact. It's a great way to practice. Those of you who have followed the channel for a while know I'm a huge proponent of deliberate practice, bar by bar deliberate practice. Spoke about it at the end of the Kuala Magi video. I ranted for about 15 minutes on deliberate practice. Interesting that Oliver trades trades or practices in a very similar way as well. Lots and lots of stocks in his database, but also bar by bar on the biggest winners. How would he trade them? What are the rules to put in place? How do you get into them? How do you control the risk? How do you mitigate the risk? How do you ride the trends? Doing it all very, very deliberately. On his learning phase, so this is back in 2010, 2011, I was reading, studying, and watching the market for 16 to 18 hours per day. This is not an exaggeration. I had one issue though. I'd get so anxious about losing all of my earnings that I would often get ticked out of stocks only to watch them then turn up and do exactly what I intended them to do. For all of my studying, I still struggled to embrace the idea of controlled risk, a vital part of my trading. So what he was saying is he would get positioned in the stock, and soon as the stock kind of pulled down a little bit, he would get really anxious and he'd go, I'm going to give back all my profit. I'm going to get out of the stock, and he would just panic. And again, this comes from studying that the stocks that are going to make the big moves, they are going to pull back. They're going to pull back into the key moving averages. If they're going to go on a big move, then they're probably going to find support around those key moving averages. Yes, as I showed you in the presentation, there might be the gap down reversal bars, the shakeout demand tails, so on and so forth, but you have to study and understand the game that you are playing and what are the rules of the game. So remember this chart. I showed you this at the beginning of the presentation. I said, can you identify where is the wick play? Where is the 2 ad spot? Where is the bull flag? Where are the wedge drops? And where is the base and break? Do you think you now know? Hopefully this is honestly to try and piece this all together and try and explain it coherently and take you from start to finish in the space of under 2 hours. I was like, how on earth am I going to do this? But if you can now look at this chart and you can identify those points on the chart, I think it has been a good use of your time to understand Oliver Kell's breakout strategy. Ready? Here you go. 3, 2, 1. There are the points. There is your wick play in there. There is your ad. See, the prior day is an inside bar. Here is your additional ad. See how the prior day is an inside bar and you get this little kind of flat base in here. Here is a bull flag as it pulls back into the key moving averages and a strong close on the prior day. Nice. Here is your wedge drop. Here is then a base and break with a little low pivot, cup and handle with a little low pivot or little low cheat, Manavini would call that. See how you get the volume dry up. There's your base and break. You could also think of this as a bit of an extension, and there is your wedge drop there. So hopefully you were able to identify all of those points on the chart. You have learned a lot in the space of about 2 hours. If you made it all the way to the end of this video, please do subscribe to the channel if you're new. Please do press the like button. If you have any questions, just ask me in the comment section down below and I will happily respond to you. Thank you very much for watching, and I will see you in a future video.